With the tariff announcement just around the corner, gold keeps pushing new highs. Will the shoe dropping trigger a sell-off, or is there still room for another breakout? Find out more in this episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Over the past week, gold trading has been dominated by the bulls, with strong risk-off sentiment driving prices above $3,100. The two main catalysts for gold's new highs have been recession fears in the US and tariff panic trading. Tomorrow's tariff announcement from Trump will be a key factor in determining gold's direction. Additionally, the US non-farm payrolls report on Friday will also catch traders' attention, as it could impact the fast rate cut path and, in turn, gold prices. Looking at the gold against US dollar daily chart, we can see that gold's bullish momentum is quite strong, with prices closing higher for 5 straight trading days. After challenging the previous high of $30.57, gold broke through the $3,100 level last Friday, reaching a peak of $3,149 on Tuesday. The RSI has entered overbought territory, indicating some pressure for mean reversion. However, despite the slight pullback, prices are still trading above the 5-day EMA, and the bulls have regained control today. If buying momentum breaks through $3,150, $3,200 will be the next target. On the other hand, the 20-day moving average around the $3,000 level will provide support for any potential pullback. Every time gold hits new highs, there's concerns in the market that the bullish factor may have already fully priced in. But in my view, although the shoe dropping on tariff measures could lead to some sell-the-fat price action and profit taking, the least resistant path for gold remains upward on higher time frames. Regarding the tariffs, the White House has already announced a 25% tariff on all imported orders, and traders are speculating that the US may impose a 20% universal tariff, with some countries granted lower rates as exceptions. Considering that the market is pricing in a nearly 50% chance of a US recession, if Trump's rhetoric turns more aggressive, I would say, for example, by implementing stricter tariffs on specific industries in certain countries, or if VAT or GST is excluded from the tariffs, this could increase the stagflation risk in the US. This could lead traders to, expect more aggressive Fed rate cuts, which would push down US 2-year real yield and support gold. At the same time, the Fed remains very dovish. This means the Fed is clearly more focused on economic downside risk rather than controlling inflation. Even though PCE inflation showed signs of picking up last week, and inflation forecasts from multiple agencies are rising, with declining consumer confidence and growth expectations, the markets do expect 2 to 3 more 25 basis point rate cuts from the Fed before the end of the year, which is quite bullish for gold. And interestingly, even if the Fed turns hawkish to combat rising inflation, further expectations of stagflation could still support gold. While in the medium term, gold purchases by emerging market central banks and some gold ETFs will continue to play a key role in supporting gold prices. On one hand, global central banks have bought more than 1,000 tons of gold of 3 consecutive years, and under the upcoming tariff pressures, the structural shifts away from the dollar in foreign exchange reserves will not reverse in the short term. On the other hand, driven by lower real yields, gold ETFs added over 5 million ounces in the first quarter, marking the strongest performance in nearly 3 years. If demand of risk hedging accelerates, strong ETF buying will continue to support gold prices. So overall, considering US stagflation risks, tariffs, geopolitical uncertainty, and continued institutional investor bets, the bullish narrative for gold remains quite strong. I believe that unless Trump makes significant concessions on tariffs, the least resistant path for gold will remain upward, at least in an elevated level. However, risks such as declining gold imports by India and speculative long positions in futures are also worth keeping an eye on. Well, looking ahead to this week, in addition to the tariff updates we've discussed, Friday's U.S. March non-farm payrolls report will also be crucial. The market expects a 140,000 increase in jobs, slightly below last month's 151,000, which could bring the 3-month moving average down to its lowest level since October of last year. Meanwhile, the unemployment rate is expected to hold at 4.1%. I mean, if the actual job numbers fall below 100,000 and the unemployment rate rises above 4.1%, increased recession risk and concerns that rate cuts might come too late can push gold prices higher. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming events and data might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!